Hey everyone, I'm Oliver Bogner, managing partner of the Advisory Investment Bank. We're a lower middle market investment bank focused exclusively on all things essential services. HVAC, plumbing, pest, landscaping, fire safety. This is all we do 24/7. I'm a 2 times Forbes 30 under 30 honoree, 2 times Inc. 5000 CEO. I've built and sold 5 different companies to private equity. I've been in your exact shoes. Most recently, my investment bank, The Advisory, for the third time in 2025, Q3, we were named top 5, actually number 3, lower middle market investment bank out of 4,000 other firms. So we're really proud to be representing Main Street in the fight against Wall Street. So today I'm going to talk a little bit about Main Street versus Wall Street, how these guys are coming in undervaluing the business day one, and how we can get that value up, right? There's a couple key things that we see really drive up value, right? What are those things that Wall Street's going to pay for? First of all, if a buyer knocks on your door, respectfully, you need to run. I have story after story after story where a buyer comes in, tries to convince an owner that they're paying a fair market price, and they are radically off. There are groups that pretend to be groups like mine that are not mine. We are sell side, meaning all we do is represent the business owner against the Wall Street private equity aggregator, right? There are groups that will call you and say, hey, I have a buyer for you. When they're making that one-off introduction, they're getting paid what's called a buy-side fee. They exist to get below market deals. Private equity firms tout, literally when they do their fundraising, how many off-market deals they've been able to get. That's a key KPI that they're touting to their LPs. Off-market deal means not fair market value for you, and they're paying below market for your business. So again, this video is going to be about 5 key ways to grow the enterprise value, but the number one thing we can do to encourage you to get the best price fair market value is hire an advisor. Whether it's us, whether it's another investment bank, you want to work with an expert in your industry that really knows who the buyers are, really knows what the value the market's paying for businesses like yours, and can get you that price. Client story after client story, and we're going to be releasing really, really great documentaries featuring some of our clients that have had this experience. I had an HVAC owner running a great business. On his tax return, it said that he was making around $200,000 a year. Now, this is a $4 million top line business, really smart business owner that knew all the kind of different tricks to get the EBITDA down, right, with his CPA. Was charging a lot on his credit cards, but knew all the tricks, right? Only showing $200,000 a year on his tax returns. Now, one of the largest buyers in the country really wanted to buy his business. Now, this is a multi-billion-dollar a year top line HVAC aggregator that really wanted to buy his business. Now, they reached out to him directly. This was before we got involved, and they wanted to get an off-market deal. So they flew out. They took him and his wife out for dinner. They bought a great bottle of wine, having fun, talking about the industry, really building that rapport, building that comfort. And they said to the owner, hey, unfortunately, we are only able to value your business off of a multiple of what's on your tax return. And the highest we feel comfortable going is 6, 7x. Now, their multiple wasn't totally off base, right? This business did ultimately trade for over 7x, but 7x isn't necessarily totally off base. What is off base is their talk track, right? They're not telling him, hey, all these one-time expenses, all these credit card things, your adjusted EBITDA is what we're actually going to pay you a multiple of, not your true unadjusted EBITDA. Now, his true unadjusted EBITDA was only $200,000. They said, we want to buy your business for $1.5 million. Right here, right now, here's the contract, sign on the dotted line. $1.5 million for this guy, definitely not life-changing wealth, right? He was already doing really well as an HVAC owner, but got him thinking, man, I really got to get my true EBITDA up. So we got involved and we scrubbed his numbers. Left, right, center, found every single penny in the seat cushion, right? I like to tell my team, we got to dig for the $100 bills in the seat cushions. We'll still look for the pennies, but I want the $100 bills in the seat cushions. And then we'll look for the $20 bills, and then we'll look for the $5 bills. We were able to find $1.2 million of adjusted EBITDA. So we brought his EBITDA from $200,000 up to $1.2 million of adjusted EBITDA. Now, The business is trading off of a multiple of that. So 7x, good price, actually pretty close to what we got the deal done for. But we went to market with this $1.2 million of adjusted EBITDA, all buttoned up. We hit the entire market in the same week. We talked to all the buyers. We actually talked to that buyer that initially made him an offer. And everyone stepped up to the plate, including that buyer. They actually said, hey, we're not going to pay you 7x, we're going to pay you 6x. But they came in with north of a $6 million offer, up from kind of the BS $1.5 million offer that they initially gave to the owner, right? So again, getting the right advisor, number one way we pay for ourselves that you can get your true value of what you're really worth. So get the right advisor because we pay for ourselves, right? It's all about coming up with what that adjusted EBITDA is and then getting a fair market value. Now, if you want to know how the story ends, we actually were able to get that owner an 8.5 times multiple off the $1.2 million number. So almost $9 million, right? Huge life-changing chunk of change for this owner. Really, really amazing outcome. But he had a buyer, really respected buyer, that told him something that was totally false. Now, I'm not calling private equity buyers liars, but they definitely did try to mislead him. We were kind of joking. They tried to steal the business from under him. And this is what there's 150 HVAC aggregators. They're all trying to get off-market deals. They want to exclude advisors from the process. They want to talk to the owner directly, and they want to pay below market. We exist to get them to pay at or above market. So number one, hire the right advisor. Number two, tell a scalable story. I've seen this time and time again. If there is an owner that is truly an expert in their industry, that's excited and passionate about their industry, and wants to grow and scale, and really believes in this story of 1 + 1 = 4, and that if they become part of something bigger, there's going to be a tremendous amount of value, that ability to tell the buyer their excitement, tell the buyer all the opportunities for improvement, tell the buyer all the different ways that they can grow gross margin, whether it's adding additional service lines, going onto a CRM, better tech optimization, right? All these different things. Telling that scalable story is critical. Literally, I ran a process simultaneously to almost identical businesses. And we, as the advisor, again, we're prepping the owner, we're getting them excited to tell the story, we're getting them excited on kind of hitting on all the key talking points. We had an owner that was really, really, really well spoken and was passionate about his industry and really wanted to truly find kind of that home. Still get paid cash, take chips off the table, but really wanted to genuinely find that new home. And then we had an owner that just wanted to leave, wasn't passionate about it anymore, didn't want to be in the business anymore, and was really looking to just leave. The valuation gap was significant. We were able to get the owner that just wanted to leave about 8 times, right? Still a good multiple, still above market. We were able to get the owner that was really, really passionate about their craft. Opening offers came in at 8, 9 times, but we were able to ultimately get the deal done at 12 times because of how incredible the owner's story was and how passionate he was about the industry and how he really knew all the levers that he could pull to get bigger, get his margin up, and really continue to grow. So number 4, tell a scalable story. Number 3, clear financial reporting. Now, once a buyer signs an LOI, and this is where we really come in, before the deal is actually closed, they do kind of more or less a colonoscopy on the business, what's called a quality of earnings. So the quality of earnings is more or less an audit where a third-party CPA firm, sometimes big firms, the Ernst & Youngs, the Deloittes of the world, these big names that you've heard, come in and actually prepare a quality of earnings, which is a third-party assessment on the business, and they're double-checking our work, right? So we come in, we present, hey, this is the adjusted EBITDA, this is where the business is coming from, this is, the types of clients that the business is servicing, right? They come in and confirm all of our work and come up with a new adjusted EBITDA. So we really like to guide them, which is why we really try to paint financials that we know are going to pass a quality of earnings. If you've just thrown your hands up in the air and said, this is the number, it's not going to pass quality of earnings. If there's lots of things that have not been cleaned up, it's not going to pass Q of E, and ultimately there will be some sort of retrade. So Getting Q of E ready data, Q of E ready financial reporting, really important. And for businesses that are of size, we would actually advise you to do what's called a sell side Q of E, where we can go to market with a completed quality of earnings. This only takes a couple of weeks to do, and then we can really defend, hey, this is the adjusted EBITDA. Number 4, reduce founder dependency. This is something that really drives up and down price. If the founder is touching every single client, if the founder is on every single sales call, if the founder is doing every single quote, this is going to radically bring down the price of the business, right? So reducing that founder dependency is key. We see this in a lot of baby boomer businesses where that owner is touching every single customer. Clients are still calling that owner. As you're prepping to sell the business and you want to get the best price, build systems, build processes, build a layer of leadership. Who is your number 2 that's really day-to-day managing that business? Who is that general manager? Who is that branch manager? Who's that person that's accountable for running the business on a day-to-day basis that is not the founder? Because the founder is not going to be there forever. The founders ultimately, whether they're sticking around for an investment period of 3 to 5 years or whether they're out in the first year, we really have to show that the founder is not the business, right? That there are systems, processes, a leadership team in place that exist and can still run at 110% without the founder. So number 4, reduce founder dependency. And number 5, my 5th way to get Wall Street to pay up for your business is build recurring revenue. Maintenance plans, memberships, service contracts. If you are a business of 80, 90% recurring revenue, you are going to get an amazing valuation. Project-based revenue, those one-time things, you do not get full credit for. So while it might be part of your adjusted EBITDA number, where you're really going to feel the impact is that multiple. So if you're a business, let's say an HVAC business doing $1 million of adjusted EBITDA, and you have 30% new exposure to new construction, I'm going to tell you the business is probably worth, because of that 30% exposure, probably 6x. Maybe it goes to 7x, but probably 6x. Now, if you're $1 million of EBITDA, you are 100% recurring. You've got 50% of your customers on maintenance plans. You've got these memberships built in. The business is going to be worth easily 8, 9x, right? And if you're already on Service Titan, 8, 9x any day of the week, maybe it gets up to 10x, right? So that recurring revenue, those systems, those infrastructure in place, really, really important. So let's break it down one more time. My 5 ways to get Wall Street to pay up for your business. My number 1, hire an advisor. Hire an advisor, hire an advisor, hire an advisor. We pay for ourselves. We really are able to talk to the entire market about the business. Now, there's a lot of buyers, 150 HVAC aggregators in the country. There's 150 potential buyers for your HVAC business. There's 90 potential buyers for your landscaping or turf business. There's 50 buyers for your pool business. There's 40 buyers for your accounting business. All of these industries have lots of private equity backed aggregators that they have to buy businesses, right? And we really have our finger on the pulse of who the market is, who the buyers are, and what gets them to pay up, right? So number 1, hire the right advisor. Number 2, get your story straight. Tell a scalable story. Number 3, clear financial reporting, Q of E ready data. Number 4, reduce founder dependency, right? Founders got to get out of the weeds, have a number 2, second layer management, systems, processes in place. And number 5, recurring revenue. So if you're looking to sell your business, you want to just talk about what the business could be worth, you want to learn a little bit more about who the buyers are in your market, we're happy to kind of look under the hood, give you a free valuation, tell you who we think your buyer is, what they're going to be looking for, and get to know you. So I'm Oliver Bogner from the advisory, managing partner. All we do is service Main Street. Our mission is to defend Main Street against Wall Street. We know exactly where we have to dot the I's and cross the T's to get you the very best price, the best valuation, the best terms, the best contract when you're selling your business. Please feel free to reach out. Looking forward to getting to know you.